Central Bank of Nigeria Communique number 92 of the Monetary Policy Committee meeting of Monday 18th and Tuesday 19th November 2013. The Monetary Policy Committee met on November 18th and 19th 2013 against the backdrop of widespread uncertainties and risks of deflation in the global economy but stable domestic macroeconomic conditions. 11 out of the 12 members were in attendance. The committee reviewed the global and domestic economic environment from January to October 2013 and reassessed the short to medium-term risks to inflation, domestic output and financial stability, and the outlook for the rest of the year. International economic developments. The global economy is currently adjusting structurally to the evolving growth dynamics in the advanced and emerging market economies. While growth in the advanced economies has resumed, growth in the emerging economies has slowed down. Global growth averaged 2.5% in the first half of 2013, same as in the second half of 2012. The United States, Japan, and a few European countries just emerging from recession are helping drive the current growth. Improvement in US output is anchored by enhanced industrial production, buoyed largely by strong private demand and extraordinary accommodative monetary policy. The political standoff over fiscal sustainability, which had just shut down the US government in October, had its impact limited by discretionary spending during the period. Strong signs of growth resumption have emerged from some euro area economies, especially Portugal and Greece. Given the changing global growth dynamic, the International Monetary Fund revised its global economic growth forecast in October to 2.9% in 2013 and 3.6% in 2014. Global inflation is estimated to fall from 3.75% in 2012 to 3% in 2013, but could rise marginally in 2014. Food and fuel prices continue to positively moderate global consumer price inflation. In light of these developments, most central banks responded by either maintaining current policy stance or moderately easing the policy rate in the last 3 months. The financial markets expect monetary conditions to remain easy through the first quarter of 2014. Indications of this came from the Fed chairman designate during Hazard's screening. In addition, the Bank of England has given signals that its QE would continue until late 2014, while the Bank of Japan has also indicated that its quantitative easing will continue until inflation reaches a 2% target. Domestic economic and financial developments. Output. The National Bureau of Statistics estimated that real gross domestic product grew by 6.81% in the third quarter of 2013, which was higher than the 6.8% in Q2 and the 6.48% in Q3 of 2012. Overall, growth for 2013 was projected at 6.87%, up from 6.58% in 2012, indicating that the economy remains on a steady growth trajectory. The non-oil sector remained the major engine of growth, recording 7.95% compared with a decline of 0.53% for the oil sector in the third quarter of 2013. Agriculture, wholesale and retail trade and services continue to be the drivers of non-oil sector growth, contributing 2.5%, 1.96%, and 2.82% respectively. The relatively strong domestic growth forecast in an environment of sluggish global growth and steady signs of deflation reflected the continuing favorable conditions for increased agricultural production and incentives for strong macroeconomic management. Prices. The moderation in consumer price inflation, which began in the fourth quarter of 2012, continued into the third quarter of 2013. The year-on-year headline inflation figure moderated to 7.8% in October 2013 from 8% in September. Also, food inflation declined to 9.2% in October from 9.4% in September 2013. Core inflation, however, rose to 7.6% in October from 7.4% in September. Thus, the decline in headline inflation reflected the moderation in food prices. The committee observed with satisfaction that in the last 4 months, all the 3 measures of inflation have continued to be within the single-digit inflation target. However, the committee noted the potential risk to inflation of increased aggregate spending in the run-up to the 2015 elections. Money, credit, and financial market developments. Broad money supply contracted by 6.16% in October 2013 over the level at end December 2012. When annualized, M2 contracted by 7.39%, in contrast to the growth of 8.24% in the corresponding period. M2 was also below the growth benchmark of 15.2% for 2013. Aggregate domestic credit net, however, grew by 7.32% in October 2013, which annualized to a growth rate of 8.78% over the end December 2012 level, in contrast to the contraction of 3.3% in the corresponding period of 2012. The annualized growth rate in aggregate domestic credit at end of October of 8.78% was below the provisional benchmark of 22.98% for 2013. The decline in M2 was traced mainly to the decline in net credit to federal government and net foreign and other assets. Overall, government spending in the second half of 2013 was moderate when compared to the earlier part of the year. The erosion of fiscal buffers through the depletion of ECA has further exposed the economy to vulnerabilities, while the fall in oil revenue has left capital flows as the only source of external reserve accretion. The federal government debt has also risen phenomenally, along with its deposits at the deposit money banks, showing that the government is a net creditor to the system. This underscores the urgent need for immediate implementation of the Treasury single account. The continued delay in returning government accounts to the central bank is added to the huge cost of government debt due to poor cash flow management. Reserve management declined marginally by 138.48 billion naira, or 2.98%, to 4.511 trillion at end of October 2013. The level of reserve money at end of October 2013 was below the fourth quarter indicative benchmark of 5 trillion by 9.95%. Interest rates in all segments of the money market reflected the tight liquidity conditions in the banking system. The weighted average interbank call and OBB rates opened at 17.99 and 16.92% on September 25th, but closed at 12.5 and 11.73 on November 15th. The capital market continued its rally with equities providing the lead. All-share index increased by 34.9% from 28,078.81 on December 31, 2012 to 37,883.53 on November 15, 2013. Market capitalization increased by 35% in the review period. Improved earnings and investor confidence in macroeconomic management and substantial portfolio inflows as foreign investors took advantage of the upswing in capital market activities. As foreign investors took advantage of a favorable domestic economic environment accounted for the upswing in capital market activities. Generally, equity market valuations remained close to their long-run median, suggesting that the stock valuations were close to economic fundamentals. External developments. The Naira exchange rate remains stable at the wholesale and retail desk and interbank segments of the foreign exchange market. The exchange rate at WDAS during the period opened at 157.31 Naira to the dollar and closed at 157.63 Naira to the dollar, representing a depreciation of 32 kobo. The average official exchange rate during the period was 157.38 Naira to the dollar. The interbank selling rate opened at 160 Naira and closed at 158.65, averaging 160 Naira 0.15, representing an appreciation of 1.35 Naira for the period. However, the BDC segment of the foreign exchange market, the selling rate opened at 162 Naira to the dollar and is currently trading at about 167 Naira to the dollar. reflecting the impact of reduction of dollar supply to this segment as part of the central bank's anti-money laundering measures. The committee noted the increase in external reserves to $45.37 billion as of November 15th, representing an increase of $1.26 billion or 2.85% above the level of $44.11 billion as at end of September. External reserves increased by $0.95 billion or 2.14% on a year-on-year basis over the $44.47 billion at end November. The committee continued to express its disappointment at the low rate of reserve accretion in spite of strong oil prices, which is a result of the absence of fiscal savings. The committee's considerations. The committee recognized the importance of taking into consideration not just the static indices at the point of meeting, but overall strategic objectives and targets, as well as the outlook for the domestic economy and the external environment, especially with this being the last meeting of 2013. The committee noted the decline in inflation and the benign outlook going into the first half of 2014. It also noted the positive impact of monetary policy in engendering a stable exchange rate regime and attracting portfolio investment, thus driving the strong recovery of asset prices on the Nigerian Stock Exchange. It noted that global monetary conditions were likely to remain loose going into Q1 2014 for a number of reasons. First, in the USA, it is clear that the incoming Federal Reserve Chairperson, Janet Yellen, does not see tapering as imminent, given the ongoing disputes around the budget and the weakness of economic recovery. In England, although recovery appears to be firmly on track, the Bank of England is clearly not going to consider raising rates until unemployment falls to 7%, probably in late 2014. The Bank of Japan is likely to continue with QE until inflation reaches its 2% target, which is a long way off, and the European Central Bank has just lowered its benchmark rate to avert the risk of deflation. For these reasons, the committee does not anticipate any major internal or external shocks before its next meeting in January 2014. The MPC also noted that AMCON is expected to reduce its debt by 1 trillion naira in December 2013. The central bank has directed that AMCON redeem its bonds for cancellation by exchanging them for FGN treasury bills on its books. Consequently, the only impact of the repayment is that the balance sheet of AMCON and the contingent liability of the federal government from its guarantee of AMCON bonds will shrink by 1 trillion naira. This is positive for the economy and the credit rating of the federal government and the banking industry. Its impact on the markets will be minimal, given that only AMCON's balance sheet is affected significantly, and AMCON is not a player in these markets. The outlook for 2014, however, portends some potential headwinds that may lead to further tightening in monetary conditions. It is expected that 2014 will be the year for QE tapering in the US and interest rate rises in Europe, both of which will lead to some pressure on the exchange rate and stock prices due to the impact on capital flows. It is also the year in which election spending is likely to take place domestically, thus bringing more pressure to bear from the fiscal side. As a result, the MPC is of the view that we are not yet at the end of the tightening cycle and may need to tighten further in response to these eventualities next year. The committee also noted that while the federal government spending overall in 2013 has not been significantly higher than in 2012, all revenues have continued to decline in spite of relative stability in oil price and output when compared with preceding years. As a result, excess crude savings have fallen from about $11.5 billion at year-end to less than $5 billion on November 14. External reserves have remained in excess of $45 billion only because of a massive inflow of portfolio funds. The implication of this is that financial markets are extremely fragile and susceptible to external shocks. The MPC again calls on the fiscal authorities to rebuild buffers in the excess crude account, and this can be done by blocking fiscal leakages in the oil sector and increasing oil revenues. the major risk on the fiscal side at present is not one of escalation of spending, but loss of all revenue. Finally, the committee formally adopted an inflation target of 6 to 9% in 2014. It also noted that ECOWAS heads of state have set a 5% target at the Convergence Council. The MPC reaffirmed its commitment to moving Nigeria firmly into being a low inflation environment in the medium term. However, the MPC recognizes the high cost of rapid adjustment and plans to make the transition gradually. Decision. Having considered the success of monetary policy in attaining price and exchange rate stability, the potential headwinds in 2014, the ultimate goal of transiting to a truly low inflation environment, and the need to retain portfolio flows and attract them in view of the erosion of fiscal reserve buffers, the committee decided as follows. 1. 9 members voted to keep MPR at 12% plus or minus 2%, private sector CRR at 12%, public sector CRR at 50%, and liquidity ratio at 30%. 2. 1 member voted for a 0.5% reduction in MPR and an increase in public sector CRR from 50% to 75%. 3. 1 member voted for a 0.5% reduction in MPR and an increase in public sector CRR from 50% to 100%. The committee has therefore decided by a majority vote of 9 to 2 to hold all rates at current levels. Thank you.
Questions? Please just line up the question. Ask your questions. Identify yourself or your media house.